Should you lease or finance a car? And what about buying cash? Is that really a good idea? In this video, I'm going to reveal what car dealers don't want you to know. So obviously, cars are a huge financial decision. They're the second biggest thing you're gonna buy after your house. So let's answer the lease versus finance debate. Let's start with financing. There's many things for you to consider. When you finance a car, this leads to you owning the car. You have no mileage restrictions, but you do have to think about long-term maintenance and more ownership costs. If the car has small dents or wear and tear, it's totally up to you if you want to fix it or not. And when it comes to leasing, you can sometimes get lower payments if the car has a higher residual value. With a lease, the manufacturer has determined what the depreciation of the car is going to be. So basically, during the lease term, you are paying the depreciation of the car. But of course, this now means you're gonna have mileage restrictions and they're gonna charge you at the end if you go over that mileage. The car has to be returned in good condition or you'll be charged for that as well. The reason why manufacturers love to push leases is because it keeps the customer coming back to the dealership and getting a new car every few years. Dealers and salespeople are constantly trying to build their leasing portfolio. Now what that does, it gives a dealer more opportunity to sell you more products like lease end protection, tire and rim protection. If you don't have those items, you'll be charged at the end of a lease. So they're trying to increase the volume of transactions by getting you to come back in more frequently. But also the dealer sells you a new car and now they have a used car on their hands, which they can then sell to somebody else, offer them extended warranty or rust proofing, things that will make more sense for someone who's actually owning the car. And since it's a used car, they're going to sell it at a used car rate, which is higher than what a new car rate is. So then the dealer makes more money back from the financial institutions since they're selling the car as a used car. So by leasing, they get you in the door more frequently and they get a used car back, which they can sell to someone else. It multiplies their transactions with one vehicle. This is a way for automakers to increase their business. Now, there's nothing really wrong or unethical about that. Obviously, they're in the business of making money, but this is why in TV shows and movies, people are always talking about their leases.
This is my DNA talking, but you do not seem sufficiently excited about the prospect of driving a new Cadillac.
No, it's great. I've just leased the same thing forever.
You can clearly tell that an automaker has sponsored that piece of content. They're trying to push the lease idea into your head. But I don't think that's the best financial move. Personally, I think finance is the way to go. Now, accountants will say leasing is better for business owners because you can write off the lease payment as a business expense. But the truth is you can do this with a finance as well. The only difference between a lease and a finance is with a finance, you have to calculate the depreciation of the car every year. Now, it's easy to do that. If you go to the automaker's website, just build and price a lease and you'll see what the residual value is depending on the terms, so you can determine what the depreciation is. The reason why accountants want you to lease is because it's just a simpler calculation for them. But if you want to finance the car, you can definitely do that and write off that as well. You just have to know what the car's value is at the end of the year. Now with a finance, you want to stick to a maximum term of 60 months. That's a 5-year term. The reason is if you stick to 60 months or less, basically, you're gonna be paying off the car as quickly as it's depreciating. So if you wanna trade in the car and get out of it early, you're not gonna be massively upside down in the car. When you stretch a car loan to 6 years, 7 years, 8 years, which is like 72 months, 84 months, 96 months, what's gonna happen is the car is gonna depreciate faster than you're paying it off. If you want to get out of the car sooner and trade it in, you're going to have a negative equity balance. What is negative equity? Negative equity means that the car's value is lower than what you actually owe on the car. The difference is going to be negative equity. If you trade in that car, they're going to take that balance and put it onto your new car loan. People roll in negative equity to their new cars all the time, and they just bury themselves deeper and deeper and deeper. Here's where things like gap insurance come in. So let's say your car gets written off in a collision. Obviously, you owe the value of that car, but your insurance company is going to pay you what the fair market value of that car is. If there's a negative balance, you're on the hook for that now. What gap insurance does is it covers that difference. Now, some insurance companies will have something called total value replacement. That means that they're going to give you the total value of what the original bill of sale had when you bought the car. But total value replacement is usually for 3 years tops. It's something you're paying in your insurance premium. But if the car gets written off at year 3.5 or year 4, they're not going to give you the total value replacement. They're going to give you market value. Even though they're continuously charging you for total value replacement, they really only cover it for a car that's 3 years or less. So you're paying this premium, but after 3 years, the coverage is not there. That's where gap insurance comes in. And especially if you have negative equity on your car, you can have a massive financial disaster on your hands. If you had negative equity, the car gets written off at like year 4, and now you owe a massive balance because the car was worth significantly less than what your loan was. So you want to ask your finance managers about the gap insurance that they have and if it covers negative equity. I had many customers specifically say, Baz, I want gap insurance on my car. They were very adamant on getting that because they understood the financial risk of buying a car and how the depreciation can cause a problem later. So stick with a 60-month term. What's going to happen is you'll have the flexibility of a lease because you're paying off the car at the same rate that it's depreciating. If you want to get out of it, you can trade it in. The value that you'll get for the car will be more or less what you owe on it, so you're not going to have a negative balance. And of course, there's no mileage restriction, so you can drive the car as you please, use it for yourself, use it for your business. If you get some dents or dings or damage, it's up to you if you want to fix it or not. You have much more freedom with the finance, plus at the end, you actually own the car. So now you can keep driving it, you can sell it, you can give it to a family member. You have a lot more flexibility when it comes to a finance, but it's important that you keep it 60 months or less. And of course, you want to consider warranty. Most automakers give you a 3-year full warranty. They may advertise longer, but the truth is the majority of them give you a full coverage warranty for 3 years. So you want to talk to your finance managers about extending that warranty to make sure that that full 5-year, 60-month term, you have warranty coverage the entire time. There's many different products out there. Some manufacturers will actually even refund you back the warranty as a credit towards a new car if you never make a claim, like nothing ever goes wrong with the car. There's other automakers like at Chrysler, when I used to work there, we had warranty plans that would give you the oil changes and tire rotations the entire time you own the car. And so the extended warranty was something that's going to save you money because in the end, you're going to pay for those services anyways, but now you're getting extended warranty for the same cost or very close to what those regular services would have costed you anyways. You also get the roadside assistance for the entire time. Some of them also give you guaranteed rental car coverage. So if your car is in for service, you get a rental car, whether the dealer has a loaner car or not. Some dealers will give a loaner car. If they don't have a loaner car, there's nothing they can do. But usually if you get the extended warranty, depending on the plan you have, the dealer will actually rent a car from a third-party rental company. So anytime you have a mechanical breakdown, you'll have a car. And your insurance company is not going to give you a rental car for regular services. Insurance companies will only give you a car if your car has been in a collision, you're making an insurance claim. I had a lot of customers make that mistake. They think they have rental car coverage with their insurance. That's only if you're in a collision and you're making a claim against a car accident. If you're just in for service, your engine light's on, your insurance company is not going to give you a rental car. So you want to talk to your finance managers about those types of plans and what's available to you. Also, if you're in a harsh climate, you want to consider rust protection and corrosion protection. So then when does leasing make sense? Well, if you're the type of person that always wants the newest cars, you want to get in and out of cars frequently, then leasing can definitely make sense. But make sure you buy the lease and protection, because what will happen is if you return the car, there's dents, there's dings, there's some tears in the seats, you curb a couple of the rims, they're scratched, the dealer can charge you whatever they want. You may end up with a huge bill at the end, which will basically cancel any good deal you think you got on the car. So it's important to get the lease and protection so you have peace of mind that when you return the car, even if there's some damages on it, you're not on the hook for those. Of course, you can try and get those things repaired before you return the car if you want to play it that way. That's totally acceptable as well. Just make sure you take it to a qualified body shop, get everything fixed up properly. You may end up saving money doing it that way compared to doing it with the dealer, but really, the lease and protection packages are very affordable and it makes a lot of sense for customers who are leasing cars frequently. And leasing works better with cars that hold a high residual value. Because you're paying the depreciation of the car, a car that maintains a higher residual means lower lease payments. Since the automaker knows that when they get the car back, it still has a pretty high value and they can go and sell it, have warranties on that as well, or sell it with an interest rate and they'll make some extra money back on the higher used car interest rate. So if you have a car that holds a higher residual value, it's better for leasing. If you buy cars that depreciate a lot quicker, then leasing really doesn't make a lot of sense. Now, if you plan on leasing a car and you're considering to finance the remaining balance at the end, you really should just finance the car to begin with, because the leasing is going to basically put you in a position where at the end, it's now a used car. So you're going to pay the lease rates, which are typically higher than the finance rates. And then you're going to pay a used car rate at the end to finance the car. You're going to end up paying significantly more interest than if you had just bought the car to begin with through a finance. So if you're going to lease the car, your best bet is to just return it and lease a new car. I would never recommend someone to lease the car and then finance it at the end. It just doesn't make sense to do that. And so what about buying a car cash? Well, the truth is most folks, when they're buying a car cash, they don't actually have cash. What they're doing is they're using money from their line of credit to buy the car. Now, line of credit should be used as a safety net or for investments like a house or stocks, or you're trying to invest in a business or something, a car is a big hunk of metal that's going down in value every day. You really shouldn't be using a line of credit to buy something like that. And also, a line of credit doesn't have a start date and an end date like a finance does. A finance term, once it's paid off, it's done. You made the same payments every month. There's no changing that. With a line of credit, life happens, things happen. You may end up pulling more money out of your line of credit. You may end up paying for this car for years and years and years, where if you had just financed it, you'd have that end date that's a guaranteed end date. And if you truly do have cash on hand, it's not coming from a line of credit, it still doesn't make sense to buy a car cash, because you can invest that cash into crypto, into stocks, into a business, and end up making back more interest than the interest you'll be saving by buying the car cash. It's still better off spent elsewhere. A car is a guaranteed loss, and 99% of the time, it's gonna plummet in value. The only time I would say it's good to buy a car cash is if you are so wealthy that you don't care about any of this stuff. You have investments, you've got businesses, you got tons of cash flow. You just don't want to deal with another finance. You want to buy the car and be done with it. You know, you're making multiple millions of dollars a year, and so buying a car cash changes nothing in your bank account. That type of person could consider buying a car cash. But here's the thing, even those types of people, when I was a finance manager, I was able to give them a plan where they could finance the car at 0% for 1 year. Now, your payments are going to be huge because you're just financing it for 1 year, but you're paying no interest. And people that have a lot of cash on hand want to keep their cash. I would say 95% of the time, I could switch those cash buyers into a finance with the 1 year 0% loan. If they can borrow the money and pay no interest, it makes a lot of sense for them. Why wouldn't they do that? And as far as the dealer, the reason why we want to do that is because we get some kickbacks from the bank, we get volume bonuses, and what we're doing is we're financing the car for 1 year. The bank pays us a reserve. There is technically a small interest rate on there, but what I would do is I would buy down the rate from the kickback that the bank would give me. So for the customer, it was a 0% loan, and then I would get a volume bonus. So we wouldn't make a ton of money on it, but we still got the customer to finance the car. They're paying no interest, and we get our volume bonus. It's a win-win for everybody. Most finance managers don't know that they can do this. It only works for highly qualified customers. If you have a customer that's able to buy a new car cash, they probably have excellent credit. The bank will give the dealer a good credit bonus because they want to get that customer's information in their system. And for the customer, if they have a lot of cash on hand, they're most likely going to have excellent credit, and they're going to want to keep their cash on hand. So it just makes a lot of sense. The only thing it does cost them is a $50 lien registration fee from the lender. Usually it's only offered by the major banks. And like I said, it has to be a highly qualified customer with excellent credit. So what are my final thoughts when it comes to lease, finance, cash? For most people, financing is the best. Stick to a 60-month term. Make sure you have warranty coverage the entire time. Remember, manufacturers only give you a 3-year warranty in most cases. You really have to go through the warranty on the manufacturer's website to find out exactly what is and isn't covered. There's no such thing as a bumper-to-bumper warranty. Bumpers are not covered. There's tons of things that are actually covered past 5 years. Some are covered for 3 years. You really have to understand what the exact coverage on the car is. In most cases, the comprehensive warranty coverage is only for 3 years. If you're financing for 5 years, you want to at least get a 2-year extended warranty on that. Now, if the interest rate doesn't change from 60 months to 72 months, you may want to stretch it out 1 extra year if you want to get a lower payment, but the best practice is keep it at 60 months. That way you know that you're paying off the car as quickly as it's depreciating. So if life changes, things happen, you want to get out of the car, and you're not going to have any negative equity because you're paying off enough of the car with those monthly payments. If you can't afford the payments on a 60-month loan, you're gonna buy a more affordable car. That's just the reality of it. Car dealers and manufacturers and salespeople want to stretch people to 72 months, 84 months, 96 months. When people ask me what's the best thing to do, it's a 60-month term. 5 years, that's the max you should go to make a smart financial move. Leasing is good if you always want the latest cars with the latest gadgets in there and safety features. Get the lease end protection so you don't end up with a big bill at the end. Your accountant may prefer leasing if you're a business owner, but you can definitely finance a car as well. You just have to calculate the depreciation of the car, which can easily be done on a manufacturer's website by going into their lease builder and just seeing what those residual values are every year, depending on the terms that you choose. And cash should only be considered if you're extremely wealthy, you got millions of dollars on hand. It makes no difference in your bank account if you buy a car cash. And even then, ask your finance managers if you can finance the car for 0% on a short term, like a 1-year finance. If you can do that, you might as well take that as well. Keep your cash in the bank and pay no interest, finance the car for 0%. So let me know below if you agree or disagree with what I've explained in this video. This is from my years of being a salesperson and a financial services manager in the automotive industry, dealt with tons of customers, and with all my experience and all the people I've dealt with, this is what I find is the best for most people. But let me know below if you agree or disagree. Let's start a conversation. I want to hear your thoughts. And if you're interested in automotive and financial videos like this, check out my video I made on my BMW 335i and how much it's costing me for the 7 years that I've owned it, from purchase price, interest, as well as maintenance. It's a great video when it comes to comparing used cars versus a new car. Thank you so much. Like, subscribe, give me a shout in the comments below, and we'll see you in the next one.